Welcome back to Beyond the Benchmark. I'm Ryan Kasper. After weeks of limited information, the federal government finally reopened, at least temporarily, ending the shutdown that had frozen a wide range of economic data. The return to normal operations means we should see key reports like CPI, retail sales, and jobless claims resume in the coming weeks, though some missed months may remain uncalculated. For now, the data picture remains sparse. Private reports suggest that jobless claims remain in a healthy range between 200 and 250,000, showing few signs of labor market stress. We'll also get the long-delayed September employment report this Thursday, even if the numbers will be a bit stale. Turning to markets, equities were mixed last week. Large-cap U.S. stocks managed small gains, but growth and small-cap names slipped, while foreign markets outperformed. Europe and Japan rose over 1% each, helped by expectations of further central bank rate cuts after softer economic data. Emerging markets also saw modest gains, led by Brazil, India, and South Africa, where an S&P credit upgrade added a confidence boost. Here in the U.S., markets opened the week higher as optimism grew around the government reopening. By midweek, the stopgap funding bill was signed, keeping the lights on through January 30th. It included some contentious spending items like expanded food assistance, but didn't address the longer-term issue of healthcare subsidies, which remain a key political flashpoint heading into 2026. Still, the excitement faded later in the week as investors grappled with the economic impact of the prolonged shutdown and rising skepticism about lofty valuations in the AI-driven tech space. The so-called momentum and high beta stocks that fueled much of this year's rally have started to unwind, while more stable, high-quality companies have lagged, a reversal of their typical leadership in uncertain markets. Sector performance reflected that rotation. Healthcare and energy led the week, each gaining several percent, while consumer discretionary names like Tesla and Amazon pulled back. Utilities, industrials, and real estate also struggled as Treasury yields pushed higher. Speaking of yields, bonds slipped modestly last week as rates rose across the curve, reflecting fading expectations for a December Fed rate cut. What was once nearly a sure thing is now a coin toss, with the market pricing just about 50-50 odds. Floating rate bank loans were one of the few bright spots, while foreign bonds were mixed but benefited slightly from a weaker dollar. Commodities saw broad-based gains, led by precious metals up several percent, followed by steady energy prices. Crude oil held near $60 a barrel, while natural gas surged nearly 10% amid early winter weather and tightening supply, both tied to La Niña conditions and strong U.S. export demand. The big picture this week, markets are normalizing after the shutdown, but the data delays still leave investors flying partly blind. As fresh reports start to flow again, the focus will shift back to inflation, labor trends, and whether the Fed's next move comes in December or not until 2026. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll catch you next week.